we've also become, I think, the largest Bitcoin-backed lender in the United States and one of the largest in the world.
So you guys are like your Bitcoin maxes. Is that an accurate statement?
I don't have anything against ETH or Sol, and I own it personally, but it isn't, in my opinion, it's not an institutional asset yet.
They were trying to squeeze out every dollar. I think BlockFi had all this pressure as a VC-backed company to keep growing, keep expanding margins. And so you start doing things like rehypothecation or entering into the grayscale trade that didn't end well at the end. We don't do any of that. We just take out like a spread on loans and we don't trade the Bitcoin. We don't move it anywhere. It's also when you enter into like some DeFi thing, you could be mixing your money with North Korea.
Of course. Yeah. That's also the very bad side of DeFi, where it's like you have no idea who you're trading with or against.
It's not about, can you give me cash? It's, are you going to not lose my effing Bitcoin in the process?
Welcome to a new episode of Derivatives Decoded. Today I've got Nate and Alex from 2Prime, who I'm very excited to have a conversation with. But I'll let them both tell us a little bit more about their backgrounds and specifically what they do today at 2Prime. Nate, Alex, thank you guys for joining us.
Thank you.
It's great to be here. Thank you.
Go ahead, Nate.
I'm Nate Cox. I'm the Chief Investment Officer at 2Prime. I've been with the company since we started back in 2019, 2020. My background, like a lot of guys in crypto, is traditional finance. Actually ran a hedge fund that focused on volatility derivatives, trading different SPX and VIX futures and options to generate yield for clients. And happy to say that translates well into the crypto world. There's a lot of volatility, and that was what originally piqued my interest in terms of how I've made the jump. Really excited to be here. So thanks so much for giving us the opportunity.
Of course. Thank you, Nate.
And I'm Alex Blume, the CEO of 2Prime. I first got into Bitcoin in 2013. I had been in the Peace Corps. And then when I got back from the Peace Corps, I was trying to figure out how to get money to people who didn't have bank accounts in rural Panama in the jungle where I lived, and learned about this service called Ripple, where you could send Bitcoin through this thing called Ripple. And I was like, if you could just get phones out to these people, you could do remittances really inexpensively without bank accounts. I went on from there to work at Merrill Lynch for a while. I met Nate at this same volatility hedge fund that was trading VIX derivatives, and then went on to start a investment bank in New York City focused on raising money for blockchain and Bitcoin related companies. I was kind of a competitor to Securitize, but we were a regulated broker dealer that could charge fees to raise money on top of just providing the software. Prior to that, I worked at a VC fund called Tomorrow Ventures that was funded by Eric Schmidt and was early on interested in investing in Bitcoin and mining related businesses. And so
when was that?
That was like 2013, 2014.
No, that's pretty early.
And then those guys, so then I moved to New York and nobody had any experience with any of this. And so my little modicum of experience, people said, oh, you're an expert in this. And so I was consulting for various Fortune 500 companies, the World Economic Forum, stuff like that. So then I started this investment bank that slowly died and went out of business in a very painful, sad, difficult way. But one of the investors in that, a guy named Mark Fleury, he sold a previous software company called JBoss to Red Hat for $350 million in 2006. And he was an early Bitcoin investor. And so he said, let's do something else together now that you've lost my investment in this first business. And I just started basically trading Bitcoin derivatives when we saw them emerge in the market in late 2019. And then we grew that with some friends. And then it got to a level where I was like, I better call Nate and someone who knows what they're doing here.
So that wasn't 2Prime yet. It was just
it was 2Prime. It was,
okay. So originally it was just like a one-man operation on yourself, and then
pretty much
started evolving into what today is 2Prime.
Yep.
Was Nate your first, the first person to join you on this journey?
He was the first call I made. Absolutely. And we just saw, this is another highly volatile asset, and Nate knows how to trade volatility. At that time, implied vol was at like 140. Like it was, you had to try to not make money. It was insane. Yeah. So, and we've just kind of scaled from there. Now we manage about 2.5 billion in assets. About $1 billion of that is in derivatives-based yield strategies to generate more Bitcoin-based yield. And then we've also become, I think, the largest Bitcoin-backed lender in the United States and one of the largest in the world. That's just been in about the last 2 years.
Well, it's something to be proud of. Definitely post that investment bank. So
yeah. I learned a lot from that failure. It was a good experience in the end.
So tell me more about define 2Prime as it is today. Obviously, it started off as a we're going to focus on yield strategies like vol trading within the space. Clearly, that has evolved quite a lot from the early days of when we started. So.
I think, and that it's been interesting because I think what we set out to do in the beginning, which was generate yield on Bitcoin, and that just meant that we focused on Bitcoin as the denominator instead of dollars. And a lot of people, it took a while for the market to come around to this idea. I mean, we work with some of the larger miners in the space, institutions in the space, and so it's more like product market fit came to us over time instead of like we went out and said, what does the market need right now? We really built this thing and it was focused on what do we want, which is ultimately we want to stack more Bitcoin. And as an idea, I think in the beginning, they're like, well, what about the dollar volatility? Because if you're going to ride the dollar volatility up and down as like a fund manager, you're going to have a terrible Sharpe ratio and all your metrics are going to be off and, nobody's going to want to invest in this. And we said, look, the main thing for us is we're going to generate more Bitcoin. And in the last, I'll say 2 to 3 years, that has changed drastically because I think, in the wake of like the strategies of the world, which is now, there's MNAV is like the new benchmark. Generating Bitcoin yield is pretty cool. And so now I think a lot of people are coming to us and looking at, how can I do this organically without just doing some sort of shared dilution or something like that? And it's not an easy thing to find in the market. I think a lot of people, and we could talk about like DATs and all that kind of stuff too.
We will.
It's
sure.
like, these guys are launching these treasury ideas now. And it's like, yeah, great. You guys are also thinking about Bitcoin as your denominator, but they haven't answered the question of, well, how do you generate yield on this Bitcoin? Or how do you make it productive beyond just issuing shares and diluting your shareholders and accumulating more, which is great. People are interested in accumulation, but I think there's still a question that has to be answered, which is how do you do this organically, or what are the products that are actually going to help you do this without just issuing debt?
Alex, who do you think is, I guess the perfect client for 2 Prime? Like your services, who's in the most in need for those services today in the space?
I think the number one fit has been large holders of Bitcoin treasuries that want to and have a mandate to grow the Bitcoin that they have, but don't have the internal team or tools to do that themselves. 10% of our company is owned by Marathon, and they're a great example where they had all this Bitcoin, and then as they've matured as a business, they have to start asking, well, what are we going to do with all this Bitcoin? And there's not a lot of people with a track record at scale in separately managed accounts that can meet all the compliance checkboxes for a public company, and we can. And so it's groups like that, but really anybody with a lot of Bitcoin, our account minimums are $10 million. And so anyone with a lot of Bitcoin that cares about Bitcoin more than dollar returns. And kind of to what Nate was saying, I think the first couple of years we were doing this, people were going, oh, well, you guys are only up 200% this year, but this altcoin strategy was up 700%, and it's just ridiculous. And so I think we fit best with investors that understand Sharpe is kind of the leading metric of an investment beyond just raw dollar-based returns. Like we're not even going for dollar returns. And so I think we've seen these treasuries and other more mature investors start to understand, hey, a 10%, 8% return on my Bitcoin every year, compounding over 5 years is an insane outcome if you believe Bitcoin is here to stay. And so that's been the best fit for us.
So like maybe both of you guys can tell me a bit more about like the operational setup for 2 Prime today. Obviously, like I'm getting a better understanding of like there's clearly a trading operation, there's clearly infrastructure involved, there's clearly like ops, risk, and then obviously you guys are extending credit like as of recently, right, to a lot of different players in the space. So that involves probably some undertaking and underwriting and all that stuff, right? So maybe explain to me like how the business is set up today and sort of how do you guys go about your day-to-day sort of operating 2 Prime altogether?
So, I could speak to, maybe you could speak to the OMS and EMS and PMS. On the business side, we're an SEC registered investment advisor. Once you get to, I think, 120 million in AUM, you have to become one. But that's, so we're regulated by the SEC. We're also an exempt NFA, CFTC commodity trading advisor as well.
And you guys are running a single US regulated entity, right?
Yes.
Does 2 Prime have an offshore like presence or no?
We do have an offshore BVI entity as well. But all the clients are clients of the US
Are US based like clients though?
We have clients both abroad and in the US, but they all contract or are clients of that US entity.
The reason why I'm asking just from a regulatory standpoint, and we're definitely going to talk about regulation, right? Like you guys have went through a lot, right? Over the past like 4 or 5 years.
Jumped through a lot of hoops.
It like how easy it is today to just take on a client worldwide, right?
Yeah.
So,
I mean, for us, we've always tried to, there's been some unclear guidance around some of the things like how you do off-exchange custody for exchanges where there is no qualified custodian that exists until recently. And so we've just always strove, I don't know, but go beyond what we could think is the best possible outcome. And we were audited by the SEC and they had no changes for us, but you don't know until they're done. But so yeah, we have this SEC registered investment advisor. We don't have a fund. We only offer separately managed accounts. We found for large holders of Bitcoin, that's what they want. They want flexibility. They want to be able to change their strategy, modify the risk parameters of the strategy, maybe add money in the middle of a month or remove it. Nate hates when that happens, but there's some greater flexibility than being in a fund where everybody has to do the same pooled investment.
And they don't want their money in a pooled investment vehicle. Generally, there's a whole bunch of different, I'll say, requirements usually that comes from our clients that says we can't be in a pooled investment vehicle. We need to be able to show separation from these other wallets.
Like silo me, show me my numbers, and give me control when I need to.
Not to mention, if you already have Bitcoin and you enter into a fund, it's often a taxable event. So we have clients with, single dollar cost basis of their Bitcoin, and they do not want a taxable event on adding some trading to what they do. So that's the trading side of the business. On the lending side of the business, we lend out of a different BVI entity, and have been doing very sizable loans. But to your point, it's nice with Bitcoin backed loans because the underwriting on one level is, the first level is very simple. It's, do you have enough Bitcoin for the loan? The loans are over collateralized, and so we're pretty protected just with the Bitcoin as the security for the loan. Beyond that, it's balance sheet, use of funds, track record, all sorts of different things like that. We've probably had 40 margin calls over the last 2 years and never a single liquidation or need to sell. And our borrowers are publicly known borrowers are like Marathon and HUD 8. And so these groups have a lot more Bitcoin behind these loans. Then maybe Nate, you want to speak to the trading infrastructure?
Yeah. I think, just to your question about the operation side, it's a lift, to say the least. I mean, to build a scalable SMA business where you have basically like 30 or 40 fund of ones is a huge, logistical challenge. So we've built out our own software, OMS, EMS, PMS. All of these things have been, and required personnel hiring. We have guys in Germany. We have teams that we work with in London, and then we have a US team. But we're all on the ground building these software systems in real time, adding features, testing features, going through different compliance and regulatory hoops, which is, the least fun part of what we do. But it just means that we have to be able to simultaneously execute across all these different accounts and randomize and all this stuff to make sure everybody's getting fair execution. But it's, as part of growing a business, I got to say, I think it's a really fun endeavor. I'm sure you can relate. You've built a business too. And, it's like there's growing pains, but obviously as you do these things, you kind of look back and you're like, wow, I can't believe we did all this.
Absolutely. What's the headcount today at 2 Prime? How big are you guys?
I think there's 17 active employees and 2 people that are starting by the end of the year. So we'll be up to 19.
This is definitely growing pains there.
Yeah. I think, and we had like 5 at the end of last year. So it was maybe 6, but I mean, it's scaling quickly right now.
Beautiful.
Yeah.
All right. So I know you mentioned earlier on, like before we started recording, like almost 50% of your business today is focused on like loans, right? Like focused on like extending credit.
Yeah.
So that's a very different side of the world, right, than just trading, right? When it comes to trading, right, clearly you guys both come from a background of sort of understanding how to execute, like, tap into markets. But then extending credit requires not just knowledge of, like how to actually underwrite a loan, but more importantly, like the setup, which I can imagine is quite severe given the regulatory sort of side of things for the past like 5 years. Now, obviously, it sounds like a little bit easier, maybe perhaps for someone to enter the space, but walk me through what does it like? What are the requirements today if I, want to replicate sort of like, that side of the business? How do I actually start extending credit, and why, did you guys decide to get into that side of things?
Yeah. In 21, 22, we were borrowers of BlockFi and FTX and Genesis. We had lines of credit with all of them. And then all of a sudden 1 week said, hey, we need our money back. And we all know what happened to those companies. And so a lot of our institutional clients were saying, do you guys know where I can get a loan? And there was just a vacuum in the space. And so I thought, maybe we can give these loans out. We already have an established business and we have the clients to do it. And so, for us, it's really not so much the hardest part of it is finding money to lend. We don't have $1 zillion on our balance sheet to lend out. But we do have partners that are, banks, family offices, private businesses that have a lot of cash and are interested in a yield that beats treasuries. And so I think when you go to a US regular, if you go to Wells Fargo, they go, this is a super high risk loan. But in reality, these are way oversecured loans with tons of buffer before you lose money on any of these loans. And our borrowers are of institutional quality. So we set up a new entity, we set up credit facilities and started looking for borrowers. And I mean, I thought maybe we would do, $100 million of loans year one. And we did like $1.5 billion of loans in 9 months of last year. And I think we've done total about 3.5 billion in loans in the last 2 years. And we just found, like we thought, kind of a vacuum in the market, but it was just based upon kind of what our clients were asking for. And it was, there is complexity to managing a loan book and making sure you have duration, matching and that the cure periods on these loans all fit, stuff like that. But relative to the complexity, I think, of running an algorithmic derivatives trading portfolio for 40 different clients, it's simpler than that. We've also built software where, if there is a margin call hit, clients get an automated email, so they're notified in a timely basis to get the Bitcoin in. And again, because we have institutional clients, we don't like auto liquidate anybody. We're in close communication with the clients we have. And so if they're even, they're like, hey, we need 3 more hours, we don't want to sell anybody's Bitcoin. It ends the relationship and it's bad for Bitcoin in general. So I
think one important thing, when it comes to like underwriting risk on these loans is understanding who you're lending to. And, I can't speak to the 21, 22 clientele, but I suspect there was a lot of people there that did not have enough BTC to re-collateralize these loans when things went down, obviously. And, the size of the move was drastic enough to really put people in a bad place. But one of the things that we focused on is we've been an institutional company, which is to say the majority of like our big clients and the majority of our AUM has always been institutions. Lending to institutions is, at least in my opinion, significantly more secure than lending to retail. There's just so many different vectors where things can go wrong if you have many different clients that have, I'll say, unproven Bitcoin reserves versus for our clients, we know what they have. I mean, a lot of these guys have public wallet addresses, so we can, we see or they report as a public company how much Bitcoin they have. And so lending to the biggest guys in the space is, for us, it's a great part of the market to serve because, we know underwriting their credit is much easier to do than, say, 2 or 3 rungs down the ladder where you're just not sure what this margin call is going to mean to somebody that wants to borrow, on 100 Bitcoin.
And also, I think our motto on both sides of the business is to try to keep things as boring as possible. So, a lot of those lenders in the previous cycle, they were trying to squeeze out every dollar. Like, I think BlockFi had all this pressure as a VC-backed company to keep growing, keep expanding margins. And so you start doing things like rehypothecation or entering into the grayscale trade that didn't end well at the end. And we don't do any of that. We just take out like a spread on loans and we don't trade the Bitcoin. We don't move it anywhere. That's what the market wants. And that makes our lives a lot less stressful.
That's the institutionalization of these markets, right? That is what Bitcoin is growing into. That's what, and even some of the other ETH and Sol, these guys are all going institutional because people don't want rehypothecated. It's like, show me a cold wallet where my Bitcoin is sitting and I'll feel comfortable doing this. And I can, re-collateralize at whatever level we go to. But I think that's the natural progression of what we're going to see. It means lower vol in the space. It means, more shallow troughs, and maybe, the peaks aren't as sharp. But at the same time, I think steady and sort of up and to the right is something everybody can be on board with if we can eliminate some of these sort of jagged points in the sort of trajectory of both price, but also just growth. And that's something that we want to be a part of. I mean, we look at it as like, if you're a safe and secure lender into the space, these are the things that organically help businesses grow, that, helps the market become more secure, more dependable. So that's the role I think we're playing.
And I'd add also that I think because of our derivatives background, we've been able to create some structured product type loans. For example, loans with no margin call, and you charge a higher rate, so you can use derivatives to cover those margin levels with derivatives, or loans that only pay interest at the end of the loan, an original issue discount bond. Or there was one other form. Or lower LTV loans that charge a much lower rate. All these things have been things we found popular for both private and public companies. And I think because of our derivatives background and our setup already, we're uniquely suited to easily offer those kinds of things.
So what are the biggest pain points, I guess, from an evolution perspective for that credit extending business, right, that you foresee in the future? Obviously, there's been a lot so far that you guys have been able to overcome, but then I would argue it's still in its infancy, right? Just,
Sure.
The credit side of the world for digital assets is still nowhere near where it needs to be, right, in order for this market to continue maturing. And obviously, you guys are going to continue to play a role, right, in this part of the story. So what are you foreseeing as sort of the next challenge, right, to grow, multiply the business 4x in the next couple of years, right? What needs to happen here?
Honestly, to me, it's about focus. It's saying no to a lot of stuff. I think the two business lines we run by themselves could be multi-billion-dollar businesses. And there's derivations of a yield strategy with higher volatility, or maybe more risk, or maybe it has a dollar feature or something like that. And so I think there's derivations of those products. And on the lending side, we kind of talked about some of these newer structured products. On the lending side also, it's always finding better sources of capital and lower costs of capital as it becomes increasingly competitive. And I think above all, it's maintaining, these are our products, but we have trust with our clients. It's not about, can you give me cash? It's, are you going to not lose my effing Bitcoin in the process? And that's really what people are paying for. Or it's it's very rare. People are going to send you their Bitcoin and let you trade it in ways most people don't even understand and say, okay, I trust that.
Well, people do business with people they trust, right?
Exactly.
Yeah.
So that's what matters. Regardless whether it's $1 or
Yeah.
a zillion dollars, right?
Yeah.
But it's
totally.
if you get it right, 99% of the time and wrong big 1% of the time, that's the end of your business. And so I think it's do no harm and stay focused. And we get people want us to do loans on some coin I've never heard of, and they want us to trade an altcoin strategy, all sorts of stuff. And it's mostly just no, and just focused on Bitcoin.
But just to be clear, today, 100% of your loans are only Bitcoin-backed loans, right?
Yes.
Nothing else.
Yep.
Yeah.
But I'm guessing you're exploring perhaps other blue chips that now have
No.
ETFs around.
Not
ETH,
interested.
Solana.
No.
No.
But
We
there is demand though, right?
For sure.
Yeah. I mean, there's demand for heroin too. It doesn't mean I'm going to sell it to people. I think that we did once a altcoin backed loan, and the
So
thing
you consider Ethereum and Solana as an altcoin from your from your perspective in terms of their
I guess-
credit rating, I guess.
I consider it not Bitcoin.
Okay, so you guys are your Bitcoin maxis. Is that an accurate statement?
I think not in the ideological, political sense. I don't think eating steak and buying Bitcoin is going to solve all of our problems.
Okay.
But I think as an institutional asset and a good long-term investment, I think Bitcoin is far and away better than anything else in the crypto world.
And I don't have anything against ETH or Sol, and I own it personally, but it isn't, in my opinion, it's not an institutional asset yet. There's still things in terms of the volatility of ETH and Solana, and also the narrative behind these things that drive them that, in my opinion, don't make them as sound as Bitcoin. And therefore, we've traded all of these things. I've traded ETH derivatives and Sol derivatives and all of the different, sort of down the spectrum. And my experience is that, even ETH still acts very much like a meme coin as recently as this year, where it dropped to whatever, 1475 intraday in Feb or March. And now it's back at 4K. And it's these are pretty drastic. And if you're a derivatives trader or if you were lending on this, you would have probably seen liquidations. I'm sure there were lenders that were getting liquidations because the steepness and volatility there was so severe that.
But the counter argument
become
there
hard to manage.
is also valid for Bitcoin, right? Vol is still, sure, it's a lot better than it used to be, but still obviously
Sure.
clearly there.
Yeah,
right?
yeah. And I think all I'm saying is that we've chosen not to use it as collateral, but I know there's a market for it, and I'm happy that, you know, people can borrow against ETH. It's just, I think what we saw was the opportunity for us to scale it, and it's almost inversely, or, you know, sort of backward thinking, but it was like, by saying no to these things, our business has grown exponentially because we focused on the largest addressable market.
I think as I've grown older, I've learned to be successful. I feel like when we first started, it was like, whoever would talk to us, whatever they wanted, the answer is yes, we'll do that. We'll do, we're the best at that. We'll do that.
Yeah, like the early days of like a company, like you gotta find a way to make it happen.
Right.
Yeah. And I think as I've gotten older, I've realized I don't have to be all things to all people. Like there's a community and a market fit that we have for what we do. And we can be the best at that. And trying to be the best at 10 other things means you're just not going to be good at anything. So I think we really like a more narrow focus.
No, I absolutely agree. I want to get a little bit more technical with you guys, actually, because this is now becoming a little bit interesting, right? So let's shift over to the trading side.
Yep.
Right. The origin story of 2Prime, yield bearing strategies, right, across derivatives, specifically focused on Bitcoin.
Yeah.
Walk me through your top, like sort of like 3 trades, right, as of today. Like, how do you guys generate yield on derivatives? What's, you know, your edge without giving away your secret sauce, but just kind of like, you know, let's simplify it as much as possible on what does it even mean to generate yield within the derivative space.
So I think, you know, for us, yield is basically just a function of consistent alpha or returns on your Bitcoin.
I think, just to interrupt you, you know, the real question is, how do you produce consistent, high, sharp yield in all market environments?
Do you guys have a target that you consistently, like, you know, try to meet every month or every year that you like try to communicate outwards?
Each client, we define a max drawdown, and it corresponds to a historic yield target you should expect. And so we talk more about what's the max drawdown on a month-to-month basis that you're willing to experience.
Mm-hmm.
But to go back, it's really, I think Nate's built a system that's more about consistent returns in all market environments. And maybe you can speak algorithmically how we do that.
Yeah. I think to the 3 trades question, we use a combination. It's very systematic, but the sort of pillars of our trading strategy are built on trend following, mean reversion, and then vol. So we use like CTA style trend following and mean reversion strategies, or derivatives of these ideas. And we express that through perpetual futures, derivatives, options, all these sort of different tools that we have at our exposure to basically at disposal to generate, you know, our net portfolio position. And then on top of that, add some sort of long short vol characteristic, which, as I'm sure you know, is going to use different sort of calendars, ratios, spreads, all these different ideas. And we're going to deploy these into opportunistic sort of market regime, which is going to be some calculation on like an implied versus realized vol, or some sort of spread, some sort of term structure trade if we're looking at, you know, the curve over time. But ideally, we're able to calculate some directionality in the market, and that's going to be like a trend and momentum strategy, and generate returns off of that. There's going to be some kind of a mean reversion, which is basically a, you know, on the other side of trend, right? It's going to capture some type of flat market regime.
We should call it trend and not trend.
Yeah, trend and not trend. But, you know, the idea being these things both offset each other, reduce the volatility, lower the cost of carry for something like a trend strategy, and then also generate positive total return by, you know, simulating both long and short positions at the same time.
So it's, I guess, most of your trading strategies are systematic, right?
Yeah.
Nothing directional, like
there is directionality, but it's systematic in terms of how it's.
But deployed. I mean, like, there's no 1 p.m. somewhere that like has some discretionary sort of, you know, opinion on the market and kind of just goes purely directional. Like, it's just you guys have a clear sort of risk parameter that you follow across every single strategy. Like, it needs to be systematic, right?
Exactly.
I think for institutional clients, I think they actually care more about predictability than they do about a specific return.
Like,
and so if you can tell people, here's how we lose money, here's how we win money, and then that's the way it goes, people can live with that. They can fit that into their larger plans. But if it's just like, I think it's going up today and we were wrong, like that is not a way institutions can work with somebody.
Yeah. Got it. You guys you don't like expect in the future to offer some opportunistic sort of fund kind of like structure, right? Like, in a sense where if I wanted to get exposed to a little bit more yield,
I think more if somebody wanted higher yield, we would just say, why don't we size these trades up bigger for you? Like if you want a 20% yield, it's just the 10% yield with twice the sizing. Everything we do is usually risk-defying trades, call spreads, put spreads. And so it's very low margin usage, or even doubling or tripling the sizing of the trades does not come anywhere near a liquidation risk. And so that's mostly how we talk about it. And then look, we're very busy like making these algos better. And so the idea of launching a whole new fund right now, I think is, again, unfocused. Like people like what we're doing. And I think we're trying to be the best at that. And I mean, I have like my personal account where like, if you look at I'm short and long perps at all sorts of crazy times. And I can suffer I don't mind a 60% drawdown on my Bitcoin because I believe in the direction over time, but that's not many people want to experience that.
Yeah, it's not an easy strategy to sell either, right? It's like,
most can't stomach like 60%.
And frankly, a lot of people have exposure to this through either their own personal portfolio or some other fund manager that has a leverage position on that basically says, there's plenty of like alt index funds now or products where you can be like, yeah, I'm going to own the top 30 and it's going to rotate market cap and it's going to rebalance and all this stuff. And I'm like, great, you have exposure to the sort of leveraged alt meme coin plays. We're here to be your Bitcoin yield generating strategy. I don't need to be super directional. If there's any time where we are like, quote, discretionary, it's when we see binary event risk like last year at the election. That's a time where we would say, don't be short vol into a large binary event. That and the ETF are the two examples I give typically where we would say, there's a time to reduce our total exposure. It's into big unknown events that have these binary outcomes, but that's about it.
And even that is really more just a sizing function of the algorithms. It's not like we're going to put on a special trade. It's like, maybe let's tamp down the short vol aspect.
Like turn down your short vol trade. That's the discretion.
So from a flow perspective,
100%
of your flow is on screen today, like towards like exchanges, venues, or are you guys doing any OTC trades as well? Like walk me through, because obviously as someone like, running Kemet, we clearly see sort of like, where the market trends are. And like for options, for the longest time, a lot of options were just being traded like over the counter.
Yeah.
Today, liquidity is getting better by the second, even by the day, right? Like, and you can now easily sort of run size on Deribit, like, and not move the market 1,000,000,000%, right? Like
Correct.
Before. But I guess maybe tell me more about what you guys are like seeing today in the market. Like, are you able to move 100% of your flow on screen, or you still find it challenging sometimes?
For the most part, yes. I mean, we trade via API, obviously. So we have different like TWAP, VWAP algos that are going to push orders through over certain periods of time or during certain parts of the day.
It's also, that's on screen, but there's block trading and
no, of course, that's fine. But again, for the blocks, are you are you like using Deribit's like RFQ like natively, or are you still pinging someone on Telegram to give you a quote and then blocking with them over
So we've used Deribit RFQ. Some we still use Paradigm for large order flow, but it's it's still based on the same signal that was generated. It's just if we have certain trade sizes that are large enough, we'll go use match on Paradigm. But it's it's more and more systematic. To your point, it's like the depth on Deribit has definitely gotten better over time. And I think you mentioned this before we started recording, but like with Coinbase, my expectation and my hope is that the book continues to get deeper and deeper, spreads get tighter. And, it should, especially if what I think will happens, which is they should eventually open markets up to US traders. And that would be a massive boon to derivative flow if we see this massive clientele on board in both retail and institutions. I know Deribit just launched their USD denominated perpetuals and options. Mm-hmm. And theoretically, this will compete directly with like CME in a way with some of the like IBIT MSTR strategies as well, because they're dollar denominated. So we'll see. And then obviously, some of the other venues, OKX, Bybit, and Binance have the option order book there is pretty shallow, but the perpetual futures there are something that we look at quite a bit just because they have significantly more volume on the perp. So that's something that, we'll consider when the time is right. We need to diversify through different exchanges. But But yeah, I mean, we've been Deribit traders since the beginning. Obviously, it's still 87 or something % of all the option flows. So we'll see if that changes. I know everybody's been nipping at their heels and everybody's saying, "Oh, this is the end." Somebody's going to take market share, and I'm like, "Show me the proof." I keep waiting for this to happen, and it still is yet to really shift.
I've even had other exchanges go, "Hey, we'll give you $10 million of our money to trade," but it's like, there's nothing to trade here. There's no volume, and so there's kind of a cold start problem with why would an institution move off? No one wants to be the first to move on to something else. And I think other exchanges have struggled to build up market share. I think if either Deribit or some other exchange in the US creates bitcoin-denominated derivatives, that's a huge opportunity, but regulatorily a difficult thing to pull off, I think.
Got it. And I guess what are your thoughts on the PBs in the space? Like, you guys work with any of the prime brokers at all? Or, I mean, naturally some of your clients are already interacting with some of those PBs. Like, tell me more about how's 2Prime set up with all the different PBs in the space, right? From an SMA perspective, some of your clients, their accounts are directly tied with their prime brokers, right? No. Oh, wow. Okay. I thought you mentioned, I mean, I would have guessed given that the focus is on institutional sort of clients, most of them are not actually going through any of the PBs in the space?
No. Either we have sub accounts for them if they are trading, or if they're non-US, they have their own setups at Deribit or some custodian connected to Deribit. The only thing we really use prime brokers for is just buying or selling spot Bitcoin. If clients want to send us cash and we'll buy the Bitcoin for them, or if we need to pay a bill and we need to sell Bitcoin to pay our bills or something, we'll sell it through some of the better known prime brokers, but not really beyond that.
I think for us, because we've been so singularly focused on Deribit, we haven't had the need for cross exchange margining or any of these types of relief. Maybe that will change over time. As we expand our universe to multi-exchange, I can see there's a world where we want to use a prime, or we would have to do our own collateral management on these different exchanges. And we've had conversations with, I know you had Hidden Road on recently. Mm-hmm. So we've got a relationship with them, and some of our investors are familiar with that.
If you're doing a strategy that goes for 8 or 10% yield, and the fee to use Hidden Road's prime on these exchanges is, I don't know, 4 or 5%, it's kind of a non-starter.
It would eat into, but then obviously when you talked about cross margining, right? Then there's some necessity there. They kind of start figuring out how to eat some of those costs. But given the fact that you guys are on a single venue today, right, that makes a lot of sense. But then have you started exploring what that multi-venue world might look like? I mean, not just forget about the infrastructure side of things, but I guess I'm more interested in sort of how are you guys looking at, I guess the CME versus Deribit, for example, right? Because there's obviously clearly some ARB there, right, that you can easily sort of tap into if the the setup is there.
Yeah, that's something so we've actually been working on. We did a press release recently that we're doing a multi-manager, an emerging manager program. So a lot of the guys that we talk to and work with now, they're on multi-exchange. And so it's something that, we're looking at more and more. In a way, we get access to these strategies through our sub-managers, which is great. But yeah, there's definitely opportunities for cross-exchange funding rate ARB that we've looked at on, both BTC pairs, but then you can go down the list. If it's delta neutral, it's something that becomes interesting, but it's just not, again, it's not in the universe for us because we've really built a business that's been focused on Bitcoin as the denominator asset. Mm-hmm. But I think over time, it's something that we'll continue to explore. As we look at these things, there's a decent amount of compression in these different cross-exchange ARB trades. So we'll see what it looks like, when we get to the bridge. But we'd certainly have to keep all of these things on our radar because you want as much access to liquidity and to capacity. And so, we have to keep all of these things in consideration.
And I'll just clarify, this multi-manager program is just with our own prop capital.
Yeah,
so we're not.
Yeah.
Got it. Absolutely. So we quickly touched on that earlier in the conversation. I'd love to get your thoughts, obviously, on is this a bubble that's going to blow up in everyone's face, or what do you guys think?
I think the history of all of Bitcoin is every quote unquote cycle is shallower and narrower. And so I think as you diversify into more institutional holders of Bitcoin, those dips are lower. The amplitude of moves upward are
Actually, let's take a second to explain what a DAT is, I guess.
Sure.
I don't want to use
sure.
acronyms. So yeah, maybe you guys can like walk us through what's your idea of like what a DAT is, and is it good, is it bad, right? You guys obviously clearly have a clear idea of your thoughts on this market altogether.
Yeah. I mean, for digital asset treasuries, I see them as Bitcoin holding companies that by becoming public companies with human management add a number of new.
Well, but it's not only Bitcoin, right? Like
Well,
there's,
sure.
yeah. So
all sorts of cryptocurrencies, but
yeah.
inside of a public vehicle, which opens up a new set of tools, capital markets functions, M&A and merger kind of functions. And then, a lot of those DATs, at least in Bitcoin, then hire us to do what we do. And so there's a lending and trading aspect to it that you can't get through raw Bitcoin exposure. And so, by adding this human layer, you're effectively adding volatility. Like you're saying there's more possibility for something good to happen, and there's a lot of possibility for something bad to happen. And there's also a new layer of overhead expense. So if something productive doesn't have that Bitcoin, it's just a higher fee expense than owning like an ETF or just straight Bitcoin. And so that's how I understand it.
Yeah. And to the question, is it going to blow up in our face? Obviously, I can't truly predict this, but I think there's certainly a possibility that things go poorly, which is to say some of these guys are, they're measured on this multiple, which is MNAV, which is basically like their share price to Bitcoin holding. And if you're at a 1, it's basically you're even. And if they trade sub 1, there's a problem.
Yeah.
Right. And that's kind of, to Alex's point, it's like that's an indication that the managers of this treasury aren't doing either a good job or they're not doing what they said they were going to do. That said, I also think there's demand in the market to then buy these treasuries at a discount because you're basically buying Bitcoin at a discount. And if you can do that, there's this arbitrage opportunity that in a way will protect the market from some sort of catastrophic event, right? If these things trade at a 0.7, I suspect somebody else with more money is very interested in picking up Bitcoin for 30 cents or 70 cents on the dollar, 30-cent discount.
We saw one just yesterday with Strive
exactly.
and similar.
Right. So, I'd like to think, and again, it gets back to this sort of institutional approach to Bitcoin, which is really changing the landscape and, it's softening some of the sharp edges because even if you look out and go, what's this crisis going to look like? I do think there's sort of a put on Bitcoin right now, which is people are looking to swoop in and buy at whatever sort of downside target they have. If it's 100, great. If it's 90, amazing. If you can get it sub 90 again, I think people will be right there ready to buy it. I think there's a lot of institutional and like investment, retirement, these guys that really haven't taken a proper bite. I think those guys are kind of the next wave. And then the sort of last point is the big print, which is underway right now or sort of in the process, which, is I expect there to be monetary easing over time, which, Trump is pushing very hard to create via the replacement of Jerome Powell. And that's something that will certainly happen in the not too distant future. May of next year is when it will happen. And you see this being priced in right now to like gold markets, for example. Gold is looking out and it is just screaming higher because it's basically saying, hey, there's easing coming and, we're going to get ahead of it. And I think Bitcoin will lag a little bit behind that. I know Alex wrote recently about this phenomenon, but there's generally about a 2 to 3 month lag between Bitcoin and gold. So, we'll see if it plays out like that. But really, these DATs as like these treasury companies, they're part of this sort of accumulation process that's happening at a much higher level. I think they have much stickier hands when it comes to buying and holding. Their goal is to never sell and ultimately figure out what to do with Bitcoin. And this is now it comes full circle, which is, how do you actually manage a treasury? And you have to start thinking about Bitcoin as like, this is your reserve asset. Now, what do you do with it, right? I got to lend it. I need to trade it. I need to put it to work.
I think also, these DATs are a version of a closed-end fund. And so even if they're trading below NAV, it reduces their ability to do convertible debt or ATM shares to raise money. But they're really under no obligation. Like they don't have to sell the Bitcoin. And I think that's one of the big unknowns is if you see severe discount to NAV on a lot of these, how do they behave? I think the options are sell Bitcoin to buy back shares, take out a loan against your Bitcoin to either buy more Bitcoin or buy shares, or just hold on and try to manage the communications with your investor base.
Yeah.
So I think that's kind of the unknown is how that plays out. And maybe like what makes sense for the first one, it might make sense for the first one to take a certain action that number 10, it doesn't make sense for. And so there's kind of I think game theory aspect to how that all plays out too. But for the people managing these DATs, like they own that Bitcoin. Nobody can take it away from them. And I think that's maybe overlooked by a lot of more the retail investors getting involved with this. Like they're getting paid their fees. They own that Bitcoin.
But I think that's the big concern though, right? Like if these treasuries are like poorly managed, it's going to be a very bad time for a lot of people, right?
Yeah.
Like
that's true of like any business or any fund, like if there's
except
bad
that no
actors-
one's talking about this aspect at all, right? With this hype, right, about DATs, right? No one is talking about like what the downside might look like if, this random company out of nowhere, like that's been struggling on the public markets all of a sudden, right, is seeing all this demand and operationally, like they're garbage, right? Like that's why their share price was down in the first place.
Yeah.
And they're going to continue on that same path with their treasuries, and that is going to be.
Well, I think there's a few categories of these DATs. I think like Block is a great example where they have a thriving business and they just believe in Bitcoin. I think they own like $800 or $900 million of Bitcoin. The head of the Treasury speaking at our event tomorrow. But this is not, the business is not, we own Bitcoin and get leverage on Bitcoin. It's like, this is a component of a Treasury strategy.
Yeah.
There are groups like Strategy or MetaPlanet that were effectively failing businesses that said, but pivoted early. And so they caught a wave and kind of were pioneers in that space. And I think they've established a foothold. MetaPlanet has unique interest rate dynamics within Japan that give them an advantage. And then there are, I think, another category, which is like Strive or Nakamoto that have accretive strategies where we're going to launch, Nakamoto's launching new treasuries in different jurisdictions, or Strive is doing M&A and kind of more asset management based kind of strategies to accumulate Bitcoin. And then I think the last category is just complete desperation. Like we're about to go out of business. Our biotech drug didn't get approved and we're going to slap Bitcoin on the name here and hope the market price goes up. And I would avoid that last category.
I think there's a lot of those, unfortunately, these days. But
yeah.
Got it. All right. Well, it's interesting how you guys like are seeing sort of like this split between these companies altogether.
And I would add also, like, just like we were saying about the miners before, there's sort of a maturation to these businesses where, right now I think they're figuring out like what custodian do we use for this Bitcoin? And as they mature, they start getting into things like, a lot of them, if you look at their marketing decks to raise for these DATs, they have a bullet point that says yield or lending. And it's like, that's not a simple thing to do. Either they hire groups like us to go quickly, but if they're going to stand it up themselves, it's going to take
a while.
Years.
Yeah.
And so I think that part hasn't quite arrived yet.
Fully thought of. Yeah. It's just kind of, well, I think, like I said, that's why that's the concern, right? Like that hype. It's like, let's just ride the train.
Yeah.
Announce out there that we're, now associated with Bitcoin somehow and hope for the best. Right?
Yeah.
So
I think, there is something to this thesis, and it's kind of the undercurrent. It has been the undercurrent of Bitcoin since its inception, which is, and I'm not saying all these DATs are believers in this, but it's a fiat hedge, right? And so for the guys that, and it may not be just the pure DAT, like that last category, I agree, there's a lot of desperation there. But for the guys that are using this as a way to diversify away from strictly USD exposure, especially in a world where maybe they're anticipating that the dollar isn't the currency that it is right now, that's a play that I can get behind in the sense that these guys are trying to do something that is financially responsible for a company that is a real company. There is a prerequisite that these guys have a business, but I can see, I don't know if MicroStrategy has probably gone so far to the one side that I don't know that they even make any money, or I think they're
very little.
Yeah, barely
to their side.
Yeah. The cash flow is so small as a function of their asset value. It's like a couple of bucks. But the point I think he kind of made at the beginning was like, we don't want to just hold dollars, we want to hold Bitcoin. And that's a play that I think, that's sort of the purpose of Bitcoin. And it's it's at least a case can be made for why these guys will survive if you do see this sort of thesis play out. Is, well, number will go up if certainly if dollar continues to struggle, and that's been a trend now since January, and we'll see if it continues. It's not the reason I want to see Bitcoin appreciate, but it certainly is a case for why it should continue to go up.
Are you guys exploring like yield strategies on chain at this point? I mean, obviously early on, you've always been
we have. It's just not something, again, from an institutional standpoint that we can really get behind, because most institutions aren't ready to take DeFi risk, smart contract risk, any of that.
The first question a company asks you is, where's the custody? And the answer is not good for any DeFi yield strategy. Like, the answer is there isn't any. And it's just, that's not going to pass SOC compliance. That's not going to pass their regulatory team, tax audit. And so it's
so none of the large custodians today are able to provide that sort of relief. I thought most of them provide some level of access.
For example, you can use Copper to access DeFi. Yeah. And what that means is basically you can just create two signers to enter into a DeFi protocol, but your Bitcoin is your whatever asset. It's not a Copper anymore. It's wedged into some smart contract or something. And that's just not going to fly. Yeah. Or, the novelty of it, the lack of regulatory oversight, AML, like, it's also when you enter into like some DeFi thing, you could be mixing your money with North Korea. Like,
of course. Yeah. That's also the very bad side of DeFi, where it's like, you have no idea who you're trading with or against.
I'd say it's just a non-starter for most companies.
And again, that's where it is now, right? Like, there could be future DeFi protocols that only focus on being compliant somehow, right? They have some sort of authorization or
like a permission,
AML, KYC, right? There's permissions. There's all these things that they could stand up. And I suspect this will happen because over time, the market will, determine what sinks and floats. But I think that there's a future where that exists. It's just, again, it's not there yet.
You don't think a higher yield would get these institutions to kind of...
That was what I was going to say.
Take on the risk.
If you actually look at like the yield on Babylon or Stacks or WBTC, staked on Aave, these are not high yielding strategies. So you're taking all this extra risk to make, I think it's like 0.6% yield on a Babylon, something
Babylon
like that.
Went from like 4.3 down to like half, 50 basis points.
Athena, I think, was doing...
Athena's dollar yield, but you can just, hedge funds are doing the basis trade themselves. They don't have to pay some DeFi thing to add an extra layer of risk into something that's a standard trade.
Got it.
Yeah.
Okay. That makes sense, I guess. But I don't know where that, like, where the future sort of takes us, right? I'm like, with everything happening on chain and all the DeFi stuff right now, like, I've asked this question multiple times to several guests on this podcast.
Yeah.
Do you guys see a world where institutional capital is,
I think,
fully on chain?
Institutions could do it. I think there's a lot more latitude in the private, sector than there is in the public market. So there's, the regulatory requirements are leap years away from each other.
Yeah.
I think it was yesterday I saw the CFTC said stablecoins could start being used as collateral on derivatives exchanges in the United States. And so, I think you kind of have Bitcoin becoming institutionalized, institutions becoming blockchainified, and they'll meet somewhere in the middle. But some of these, no matter how amazing the tech is, like, there are going to be legal hurdles like AML, KYC that,
if you don't know who you're trading with, it doesn't matter what the tech
It'll be a non-starter for U.S.
And so,
institutions.
A lot of that ease and access of using DeFi, like, that hurdle kills a ton of it right away.
Yeah.
And so I don't think that's going to be, whether or not that policy makes sense or not, or really does protect anybody, is a separate debate, but it's a rule, and I don't think it's going away anytime soon.
Beautiful. Well, guys, I really, thank you for obviously like showing up here today, and we've had a great conversation. But I would love to wrap this up with your final thoughts on specifically 2Prime. Honestly, I'm like a very big fan of your business. I want to understand, where do you guys see 2Prime going in the next 12 to 18 months? Where are you guys taking this?
Well, starting with tomorrow, we have a big symposium that we're hosting in New York. So We're excited to see a bunch of both clients, but also just big names in the space. It's great to sort of bring people together. Looking out over the next, 6, 12, 18 months, Our focus, I know, will continue to be on the institutional side. Hopefully some of these DATs will become clients, more of these DATs will become clients, because I think that's the big question that we as a community need to answer is how can we organically create returns in Bitcoin for the people that care about it the most? And that's a huge addressable market for us. We're on the road, so we're here. So if you're a DAT, you can reach out to us, obviously. But that's for us, that's the true north is really creating Bitcoin as the denominator asset.
Yeah. And to add, in the derivatives market, in the lending market, those things are only going to become more competitive. And so it's, I think, just continuing to improve what we can offer in that realm. And maybe there's, subversions of those products that become more interesting or get more traction as the market matures. But to me, it's just keep doing what we do better.
Beautiful. Alex, Nate, thank you guys so much for your time.
Yeah, thank you for having us.